What is up, everybody? Welcome to Why Invest Wednesday. Pumped to talk about all of the lack of clarity in the real estate world because that is truly where we're at. So, and give some people some time to pop on, but we are talking about should you buy or sell before the market gains clarity? Because honestly, no one really knows if the market is clear or not clear or what's going on. So, I'm really excited to talk to you about this and get rolling. Let me try one thing here. Looks like it's locked. Discard those. So yeah, I hope everybody's doing well. It's Wednesday, Why Invest Wednesday. We're talking about, the World Cup going on everywhere and all of that happening, and we are ready to rock and roll. So let me get set up here and go from there. Perfect. All right. Everyone is waiting for the Denver real estate market to get clear, but buyers are waiting for rates to drop, sellers are waiting for prices to come back, and homeowners are trying to decide if they should move, hold, rent, or just keep pretending Zillow knows their house better than the market does. But here's the problem. By the time the market feels obvious, the best leverage is usually already gone. Today, we're cutting through the noise and talking about whether you should buy or sell before Denver's market gets clear. And the truth is, the market feels confusing because different sources are measuring different things. And I'm Jeremy Kane, and I'm here to bring clarity to you and your situation. The number one thing I hate about social media and everything that's going on is that there's so many people telling you a blanket statement of the market. And the ultimate truth is the only person or thing that really matters while we're going through this is you and your situation. So by measuring different things such as list price, closed sales price, model home values, right? Metro data versus city data, detached versus attached, Denver Metro versus Northern Colorado. The truth is none of it really matters because the time and place is right for you. So the market isn't unclear because nothing is happening. It's unclear because different parts of the market are moving differently. So we start first to talk from a national context. Existing home sales, 4.17 million annualized in May of 2026, right? So that's where we start. The national median existing home price is 429,300, and the national months of inventory sits at about 4.5. Pending home sales rose 3.8% month over month and 4.8% year over year. So we're seeing more homes go off the market. So the fact that people are not coming out because of interest rates or things like that at the national level just simply isn't true because pending home sales are up. So that's something that we kind of have to put to the back burner. The 30-year mortgage fixed is between 6.25% and 6.75 as of June 18th, 2026. I'm not a mortgage lender, so if you want that, I can get you connected. But it was, a little bit higher the week before. And from a year earlier, we are still down, right? So what we're seeing and, all the talks of the Iran war and all of that, yes, maybe that is having an impact. But when we look back a year later, we are actually, down a little bit. So what that tells me, who knows? Rates are probably going to hang out, stay the same, whatever it is. So that is kind of where we're at. So I want to go through kind of some things that I'm seeing that the headlines are missing. So first and foremost, are buyers actually showing urgency or still cautious? I kind of touched on this already with pending home sales, but the truth is that if the time is right for you as a buyer, they're going to be ready to go. Yes, buyers are in a position in more cases than not to, especially in our market here in Denver and Northern Colorado, to at least shop, at least, digest the 15-minute showing before, going into a crazy bidding war. And what that's doing that I'm seeing is giving people some time to reflect. I've had several clients that are looking at homes, they go sleep on it, and they're like, let's keep looking, right? Or we want to get some other stuff taken care of in order before we move on that house. And that's awesome, because what that does is it helps us understand as buyer, realtor, exactly what we're looking for. And it gives people a little bit of time to think before just jumping into something and then maybe regretting it down the road, because time heals all wounds, right? So that's huge. Next, are sellers realistic or still anchored in 2021 pricing or 2022 pricing? Obviously, there's no blanket statement for this. Everybody's in a different situation. Everybody started with a higher down payment or lower down payment. And so this is really station to station, right? It depends on what their situation is, if they've refinanced, if they've had a life change and those kind of things. Obviously, if there is an absorbent amount of equity, sellers are typically a little bit more realistic. If they're tight, they're typically not. And that kind of brings me to my next point here is, as sellers right now, we have to understand that the past has nothing to do with the present, right? If you're not walking away with $100,000 of that exact price you need for the next piece, we can't make that up. We can't market ourselves to an overpriced, sale, because right now, again, those buyers have that time and they're thinking about it. They're weighing all their options and they're looking at things. So that's really, something we have to take on a case by case basis. Some sellers are locked in. I have agents who have talked to people that are like, all the homes in my neighborhood are selling for $750, but I want to get $950, right? So there's people that are looking at the numbers, looking at the data, and then saying, I want to get this. And a realistic conversation, that's just not really possible, right? Because we have to appraise, we have to appeal to the buyers, we have to have something to market. And if someone's coming to look at one house in your neighborhood, they'll probably look at another one. And when the prices are completely off, say they don't have representation and their agent doesn't tell them that, then eventually they're going to figure it out, whether it's at the appraisal, at stopping by an open house when they're there for the inspection or whatever. That's just not going to work right here. So we have to be very smart about pricing and careful, because my heart goes out to a lot of the people that are too tight to put their house on the market because the fees, or because whatever, the market hasn't appreciated at the same rate, or maybe they bid over asking and so on. So it just really depends, right? Are showings happening, but offers are weak? Showings are happening. They're still way down from what they were, but we're, in certain zip codes and area codes, we're seeing, 10, 12, 15 showings a month. And some we're seeing, 4 to 5. So showings are still happening. Offers being weak, that's a tough, kind of cookie to crumble there, because the offer is what the buyer wants to pay. And the home will sell if the buyer can buy the home for what they want to pay and the seller is willing to sell it for that amount. So the market is very different. Weak offers are not necessarily a thing. I think strategic offers are a thing. We're seeing concessions and custom built offers to put the buyer in the best situation possible, because remember, we are in a higher interest rate piece. And a lot of times when I'm talking to sellers, and I say, hey, this is kind of what we're looking at. You were a first-time home buyer when you bought this. If you had, 5% down to buy this home in today's market with today's rates, this is what, and the price we're going for, this is what the monthly payment would be. And that number shocks a lot of sellers. So we just have to kind of understand both sides of it and see where people are coming. And as far as homes sitting, because of price, condition, location, payment, they are sitting mainly because of price and opportunity. The next piece is because of condition, right? The truth is that buyers feel like they have a little bit more of an opportunity in these markets to get, a deal or get that rate buy down, get those concessions. And so that all being said, the condition isn't something that they're really wanting to negotiate. Right now, more than ever, if there's carpet or there's something going on, I'm saying, hey, can we update that ahead of time? Because the truth is, you only get one first impression. And, the more people look at pictures and the more people think about it and talk about it, because there is that time, the less they're willing to walk into, the biggest investment of their life and drop $5,000 on flooring or paint or those kind of things. So putting your best foot forward in whatever possible way is absolutely key. And then realistic pricing, understanding that, having those conversations early on is huge. And if you're in a situation where like, maybe it's time for me to downsize, maybe it's time for me to sell, please call me 303-543-1453, and we can have a no pressure, low pressure conversation about, what it looks like for you. Because ultimately my goal is for you to walk away happy. And when I walk into your house and say, "Oh, can we list it for 800,000?" and I say, "Yes, but it's probably worth 750," that doesn't matter. If I tell you we can list it for 800,000, you're going to go through the work to get it on the market, then I want that price to be actually obtainable. So we talk through that. We build strategy. We can plan, whether it's now or 2 years from now, what are some things you can do for your house. Just reach out and we can have that conversation. I won't come over with a sign and drop it in the yard. So are people confused when they hear the word balanced market? The truth is the balanced market piece and a balanced market is technically 6 months of inventory. And we're in the fours, obviously, at a national level, as I said above. But a balanced market is not necessarily 6 months of inventory anymore. I think things move a little bit differently, and that's a really old kind of marker from the National Association of Realtors. And so I think that a balanced market is where both people feel like they kind of have a say, right? And that starts with coming out fairly on the front end and putting a home on the market for a price you would sell it for, as well as a price that's, unique or, appeals to the buying pool that would move in, right? If you have a 5-bedroom house, maybe bigger families, more people, roommate situation, whatever that looks like, that's all of that stuff kind of plays into that. So balanced market isn't necessarily something that rolls. So the stats say balance for sure, right? The consumer feels a little bit confused because they go in and maybe they run into a seller that's, super strict on their price. They need a number, or maybe a buyer comes in, you're a seller and you're confused because a buyer comes in and throws out an offer. Again, it's what they're willing to pay for the property that really matters. They're trying to set up the best deal for them, just like we do for you on the other side as well. So, and that's the real gap we need to explain there. So before we start yelling buyer's market or seller's market or balanced market, like we're picking teams at recess, let's actually look at what the Denver market is doing right now. So when we're talking about Denver, we're seeing balance, but not easy. I think there's a massive difference in average days on market versus median. Like 30 average days on market and 14 median days. That tells me there's a lot of outliers, and that median price point kind of dials that in, where the outliers kind of extend the average. So the headline version is simple. Denver is more balanced than it has been in years, but balance does not mean easy. It means strategy matters again. Buyers cannot assume every seller is desperate, and sellers cannot assume every buyer will ignore price, condition, and payment. Just because your kitchen has white cabinets doesn't, do much for us. It's really the condition and what's going on. So according to RE Colorado, after May of 2026, last month, closed listings 4,054. We're down 2% year over year. Median closed price is up 3% year over year. Median days in MLS is 16. Remember, I said average days was closer to 30. New listings was down 18% year over year at 6,002. So that tells us that less new listings are coming on than a year ago. So that kind of is a kink in the armor of there's so much inventory and there's so much opportunity, because we're actually down from a year ago. Pending sales 4,232 is up 5% year over year, and inventory sitting about 13 weeks, so just over 4 months. So still not to that balanced 6 months, but it sure feels a lot more balanced based on listings and so on. So 12,259 active listings, 6,000 new listings. Pending sales was 4,134, and closed homes was 4,004. So as you can see there, the pending sales, those are ones under contract as marked in the MLS, and the closed homes are very close at the month's end. So months of inventory sits about 3.06, and median close price is 615,000. The average close price is just a tick below 600,000 as well. So what do I think of that? It's not 2021. It's not a crash. It's more balanced market. Good homes will still move. Overpriced homes will sit. Buyers are more selective and sellers have to earn attention. And I want to talk a little bit about that because overpriced homes do sit. Underpriced homes, some agents are talking about, I'd like to price it just a little bit under market so we get that, 2021 rush. Depending on how much you're listing it below market, I don't love that, right? Because there's a couple things that go into that strategy. And yes, I understand the demand and that strategy and everything. But first and foremost, things kind of change. Like weekend to weekend, buyers are out, buyers aren't out. It's pretty much kind of across the board. So if you happen to pick a weekend where something crazy happens in the world, or, it's a college graduation you weren't thinking of or whatever, where, some of the city is distracted and doing those things, you very well could end up with no offers, that first weekend. And if you're priced below market, pretty much, it does happen, but after, a weekend or 2 weekends, the chance of getting, from the current list price, it's been on the market for 10 plus days, getting over that sometimes, goes away. So utilize that strategy, sparingly, if that's what your real estate agent's, doing. I always tell people, like, I never want to put your house on the market for something you wouldn't agree to. So if I get you a full price offer, we may be going a little bit lower, but say I get one offer and it's full price. Like, we can't really counter that. I guess we could, but that doesn't do us very well in the market usually. So that's the key. And sellers have to earn the attention, right? We have to market the properties as much as we can, right? Utilize some of the social media stuff that your real estate agent's doing. Check out their Instagram, post, share that stuff and drive more eyes and ears to that. Because yes, the MLS is the #1 driver of traffic, but it's not always the only way, right? There could be somebody, that's loves your neighborhood or whatever, that's in your circle, hyper local to you, where that house is perfect. I always tell my clients when I'm going into listing appointments, hey, the person that's going to buy your home is probably you when you bought your home. So where does the market feel balanced and where does it still feel painful? This is something which price points feel most active right now. Obviously, the lower price points are a little bit more active, in my opinion. I think there's kind of a no man's land between 600,000 and $1 million, and I do know that some of those higher price point luxury listings are moving okay. It's not like they're going flying off like hotcakes, but they are kind of overperforming for their historical average days on market. But ultimately, price point isn't the only trigger. I think the listings that are turnkey, move-in ready, and priced correctly or slightly under market value are getting that attention, and that's really where buyers are, seeing. Sometimes there is a few offers in. Now, the bidding wars and the multiple offer situations are nothing like they used to be because everyone's kind of tight to the vest. We're not going crazy because we're kind of seeing what that's done. We all know somebody who bought a house for 100,000 over asking in our market. And so they're a little bit more, guarded there, thankfully. So multiple offers does not always mean like extremely over list price or anything of that nature. A lot of the offers, and here's a secret that I'll tell you from a long time ago, even when it was crazy, even when we had 5 to 10 offers, most of the offers came in very similarly on price, excluding some of the investor, Hail Marys and things like that. So which listings are sitting? So ones that are overpriced, the ones that need work, and the ones that are just kind of average, right? If you haven't updated your kitchen or haven't updated your appliances or those kind of things, those things are sitting because buyers walk in and they see, a bunch of a money pit, right? They're going to have to fix that, avocado green furnace eventually. Those things are going to come up. So buyers are asking for concessions probably more often. I think agents that are savvy and seasoned are having those conversations. Hey, if we get a $10,000 concession, you can pay, keep some of that cash, maybe buy down that rate. It's going to save you this amount, obviously with the help of their lender working through that. So does it make sense to offer 700,000 or 700,000 with a $10,000 concession? Net to seller is still 690, but what does that do for you in your situation? I think there's something, for some reason, like sellers are like, I'm not going to give any concessions. Like at the end of the day, it's just what's net to you, right? So if it's a little bit better of a deal for the buyer, like let's run with it. Inspection negotiations, truth is, like buyers are again asking for more stuff. So that's something that we need to really focus on as buyers, both of them, right? Like as buyers, we need to understand that an inspection is certainly a negotiating point, but it's not, time to work one over on the seller and get more for whatever. It's a time to educate yourself on the home and, identify any up and coming, major items that could go there, because kind of had it both ways where buyers are like, hey, I even had somebody ask to replace a light bulb on an inspection objection before. And so right now it's kind of a tweener. I think sellers are still willing to, even, with harsh negotiations on the front end, most sellers are still willing to look at the bigger things that are going to have to be disclosed anyways if they say no. And I think, again, the cosmetic things and the other things are just not there. So yeah, that's kind of where that's going. So I hope that helps. If you're still watching, throw something in the comments. I'd love to, hear that. So the market is definitely not dead. It's just done rewarding lazy pricing and unrealistic expectations. So now where are people getting spun around? One headline says prices are down, another says prices are up, another says buyers have leverage, another says sellers are still getting close to asking. So let's unpack the headlines as they're all over the place. This is where most consumers get trapped. They see one headline saying Denver prices are falling, another saying Denver prices are rising, and then they assume somebody is lying. Usually no one is lying. They're just measuring different things, which is wildly inconvenient for the public and one of the downfalls of social media, right? So according to Realtor.com, Denver's median listing price is $539,300, down 7.8% year over year. Median days on market is 46. Price reductions 27.5% of listings. So that's 27.5 price reductions. That's number's been up to 50 at certain points. And when you hear the listing price down 7.8% year over year, understand that there is a vast majority of price points, so that's really affecting that median a little bit. Prices have come down a bit, but not anything crazy. The median sales price, $634,620, which is up 2.5% year over year. So we have like a 10% gap, right? Median list price is down 7.5, median sale price is up 2.5. So homes are selling in about 18 days, and May sales, we sold 2,852 homes. According to Zillow, Denver's typical home value is $539,712, which is down 3.9% year over year. Homes going pending around 15 days, right? So what's the explanation? Realtor.com is showing listing behavior, Redfin is showing closed sale behavior, and Zillow is showing a modeled value index. These can all be true at the same time, but tell you complete contradicting stories. So what do the stats fail to explain about buyer and seller psychology? So let's talk through this a little bit. Sellers are seeing price cuts and assuming crashes. Buyers are seeing stable close prices and assuming they missed the deal. Homeowners who bought in the last 3 or 4 years may feel stuck, right? Flat prices feel painful because payments, taxes, and insurance and cost of living certainly aren't flat, right? Those are on an upward trajectory. So yes, while the principal and interest payment on your mortgage is fixed for 30 years, your mortgage payment goes up, a couple times a year when the taxes come in, when the insurance rate goes up and the premium goes up. We talked about insurance last week. If you're in Colorado, definitely go check that one out, because that's something we need to play the game on a little bit right now. But everything's higher. So people confuse not appreciation like crazy with the market is crashing, because their payments are going up because other parts of their payment, not their mortgage, is going up. And so that makes it difficult for the buyers, a little bit more difficult. Maybe they're shopping at a lower, price point. So we had a crazy run of appreciation that has now ended. Now flattening feels like a crash because people are stuck, not because the market is collapsing. So now that we know the market is messy but not dead, let's start with buyers, because buyers are the ones asking the loudest questions right now. Should I wait for rates to drop? The truth is, waiting for rates to drop may cost you, because you're going to be throwing money away for rent, and there's no guarantee that rates are ever going to go way down again. So buyers, I get why you want to wait. Rates are still high, payments are a little bit more uncomfortable, and affordability is not exactly handing out hugs right now. But waiting for the perfect rate can backfire, because if rates drop enough to make you excited, they may also drop enough to wake everybody else up who has been sitting on the sidelines and create a little bit more competition than we're seeing in the market. Not to say that when rates drop, prices skyrocket. That's not what we're here to say. But if you're in an opportunity where you can get a $20,000 or $30,000 concession, depending on your purchase price and the loan you're in, there's limits to that. But if you can buy that rate down to something that maybe you are waiting for it to get to, and you don't have to wait, and you don't have to waste that money on rent, and you can get into a home that maybe, fits and checks a lot more of your boxes, like, why not? Okay. Rates matter, but don't worship them. Current 30-year fixed rates, like I said, I'm not going to quote the rate, but it's in between 6.25% and 6.75% on a $615,000 Denver Metro median price home with 20% down, using 6.47 as a marker for interest rate. $3,100 a month. At 6%, it's $2,950 a month. Difference is about $150 a month and a half a point in rate, right? So let's talk about that. That saving matters, but it can disappear if prices rise, seller concessions shrink, competition increases, you lose inspection leverage, you have to offer stronger terms, right? And so that's where it can cost you, because right now you may be able to get a concession just to drop it to that 6% or whatever your desired rate is, depending on credit and all of those things. So let's talk about demand and where that's at. National pending home sales, 3.8%, up 3.8% month over month. National pending sales up 4.8% year over year. Denver Metro pending sales are up 5%. New listings are down 18%. What's that mean? Buyers are still moving. The buyer pool is sensitive to rates. A rate drop could bring more competition quickly. And we're not talking about the Fed rate, as you probably saw, or left the rate the same. We'll see how that plays out, as obviously he's new to that position. But a lot of people are tying mortgage rates directly to that, and it's just not the case, right? Buyers are leveraging exits, but not everywhere. In Denver City, 27.5% of listings had price reductions. Median days on market was 46. Nationally, 17.5% of listings had price reductions, and Redfin reported 59.8% of homes sold below original list price in May. So those are numbers that matter. Buyers leverage. You're a buyer out there saying, hey, this sounds like it could be an opportunity. Where's the strongest leverage? On stale listings, overpriced homes, homes with price cuts, relisted homes, attached homes with an HOA and insurance concerns, homes needing work, and sellers with clear timing pressures, right? If someone's taking their house off the market and relisting it, it's likely that they're coming back for more, right? So they have to sell. So understand that. So what does that opportunity actually look like right now? The market is full of more favorable, but the future is still unclear. Timelines matter more than almost anything. If a buyer needs a 2-year turnaround, we need to be aggressive. Okay, this is something that's important. If you are a buyer and you think you're going to be in your house for 2 years, we have to be smarter and more aggressive, because we don't know exactly what the market's going to do. So we have to find better buys. We have to find better terms. We have to have stronger discounts and a clear resale plan to avoid risky locations or weird floor plans. Risky locations isn't like risky safety wise. It's risky, like I might not work, here I may be, an hour and a half away, those kind of things. So we have to be careful about that. What's your job future look like? What's that look like? Okay. Weirder floor plans are harder to sell. It's just flat out, right? There's a reason that, single level ranch homes sell more because they appeal to more people. So be careful with condos and HOAs. HOA heavy products are something that matters. Again, they're being vastly affected by that insurance premium hike. If the buyer has a 5 to 10 year plan, we can be way more flexible. The home does not need to be, the steal of a century. It needs to be affordable, functional, and durable. Long-term ownership gives the market more time to work, gives you more time to, update that home and give it the TLC that it needs. But don't forget, life happens. So every buyer still needs an exit strategy. And, one of my favorites, as you guys know, could this become a rental? Would the rent cover enough of the payment, right? We don't have to cover the entire thing to make renting. But if you're able to, break even or come to the table with $100 for that mortgage because you have to move across the country or you had something happen, in your family life or whatever, like, okay, that's still better than, foreclosure and so on, or selling it at a discount. So that's where we go first. I talk a lot about that when we're looking at homes. Hey, if this is 2 to 5 years, like, let's make sure they can rent, because if in 2 to 5 years you're ready to move, we want to make sure that, you can move, but also be okay and not have to sell it at a discount. Is the area rentable? Is the HOA rental friendly? That's something that's key. Obviously, we don't want to get you in a situation, especially in short term, if the HOA says you can't rent the home out. And would this home still appeal to future buyers? And if you're walking in the house and you're saying, oh, it needs new carpet, it needs new this, it needs new that, so will your buyers if you don't touch those things. So make sure that you're putting yourself in that situation. I talk to my buyers all the time about this. Some people care about radon, some people don't. But if you're going to buy it and you don't care about radon, when you sell it, you're going to have to pay for that. So why wouldn't we ask the seller at least to pitch in on it while we're here? Because that's what's going to happen. So what happens if the market is not ideal when you need to move? And that's where we go back to those things where we planned and kind of go from there. Yes, historically, real estate has been a safe long-term play, but that does not mean every house is safe on every timeline. The timeline and the backup plan matter a ton. So buy when the payment works now. You have a stable income. You can keep reserves. The home fits your 3 to 7 year plan. You can negotiate meaningful terms, and you have a rainy day exit strategy. Maybe you should wait. If the payment is already stressful, you have no reserves, job or income is uncertain, and you're only buying because you fear missing out. You're depending entirely on a future refinance to afford your home. That's where we have to have those conversations. If you need to sell in the 12 to 24 months and cannot buy enough of a discount, like, maybe renting is your friend at that point. So before you wait 6 more months because of a headline, call or text me 303-543-1453, and let's run through the payment, your target neighborhoods, the inventory, the negotiation opportunities, and the backup plan in Denver Metro and Northern Colorado. Now let's talk about sellers. Sellers, don't check out because you're doing your own version of the same thing. Buyers are waiting for rates to drop. Sellers are waiting for 2021 to come back. And one of those is a financial decision. The other might just be nostalgia wearing a pricing strategy costume. So for sellers, waiting for 2021 pricing may cost you. Sellers, I'm going to say this directly. The market remembers 2021, but it is not emotionally attached to it. Buyers are not showing up with appraisal gaps, waived inspections, and thank you notes for not being allowed to overpay. That market is gone. This one still has opportunity, but it demands discipline. Sellers are getting punished for overpricing. In Denver, 27.5% of listings had price reductions. Nationally, only 17.5% of active listings had price reductions. 5.8% of U.S. listings were delisted in April, according to Redfin. Denver had 6% of listings, so we're right there in the national average. Denver had 3.1% of relisted homes. So what's that mean? Sellers are testing too high. Buyers are rejecting bad pricing. Some sellers are pulling listings rather than accepting the market. This is not a bad market for good listings. Denver Metro pending home sales are up 5% year over year. Colorado Association of Realtors described demand as steady but selective. Well-priced homes, move-in ready homes are still attracting buyers. Overpriced or poorly prepared homes face longer timelines, price cuts, concessions, inspection pushback, and just overall skepticism from the market. And now more than ever, that first impression matters. If you list too high, you burn the hottest buyer pool. You create days on market stigma, you invite lowball offers, and you eventually price cut into a weaker position. A price reduction is not always a failure, but needing one because you ignored the market is expensive. So let's talk about, boots on the ground. What is this market telling sellers that you do not want to hear? The market is being brutally honest right now. It may take care of what someone paid in 2021, 22, 23, or 24. But some owners who bought in the last 3 to 4 years may not have the equity cushion they expected. The big appreciation run gave people confidence, but that run is flattened. Flat prices feel like a crash when your payment is higher, your insurance is higher, taxes are higher, your next home is more expensive, and your equity did not grow enough to make that next move and that step up easy. This is why sellers feel stuck, even if the market is technically crashing. So the market is not punishing every seller. It's punishing sellers who are pricing off memories instead of current buyer behavior. So what should you do? Sell it now if you have a real life reason to move, and you have to. You have equity and you're okay with, playing with some of that monopoly money. I know that some of those estimates were really pretty for a little bit there and have come down a little bit, but not crazy. When you look at the gain over the time, you're probably still doing as good as you could have expected 20 years ago when you bought the house. Only when your price can be your home can be priced competitively. You're also buying and can use market leverage on the next home. This is important because if you're selling and buying in the same market, you have opportunity, and you're willing to prepare that home correctly. You understand today's buyer is a payment sensitive. What if you don't need to move? You cannot accept current pricing reality. You have a low payment and no clear next step. You're just fishing for 2021 numbers. You'd rather rent the home and the numbers support it. If that's the case, just hang out. If you're thinking about selling or moving or downsizing, turning your current home into a rental, call or text me before you make that decision off of Zillow and Vibes. Let's run the actual numbers. And so as we kind of wind down here, what I'm saying to you is that every single piece of your unique situation matters. It matters how much money you put down. It matters how much money, equity, how much equity you've taken out as sellers, how much, rainy day fund you have for, your savings, right? Because I always tell people houses break. So what to do? What do you actually do with all of this? Because the data is great, but if it does not help you make a decision, it's just a spreadsheet wearing a sports coat. So here's the framework. Do not ask, is the market good or bad? That question is too vague. Ask, is the market giving me leverage for my specific move? That is the question that actually matters. For buyers, can I afford the payment? Do I have reserves for closing and after closing? Am I looking at an area of inventory gives me leverage? Are there price reductions, stale listings in my target market? Can I negotiate concessions or repairs? What happens if rates drop and competition increases? Am I buying for lifestyle, stability, wealth building, or panic? What is the expected timeline? What is the exit strategy if your life changes? Could this home work as a rental if I had to move? For sellers, it's what is my actual competition right now? What are buyers rejecting in my price range? Do I need prep, repairs, staging, or buyer representation? Am I willing to price based on today's behavior, not yesterday's neighbor? If I sell, what am I buying next? Number one question I ask people when I go into their house to list it is, where are you going next? Would renting the home make more sense? What is the cost of waiting another 6 months? Did I buy in the last 3 to 4 years? And do I actually have enough equity to sell comfortably? Or am I stuck because of the market, my rate, my price, expectations, or all three? And for homeowners and investors, should I hold, the low rate? Should I turn the home into a rental? Does the rent cover my expenses? What happens with taxes, insurance, HOA, vacancies, and maintenance, right? Those are added costs that kind of investors see. Does selling unlock a better opportunity? Is this home smart investing or emotional attachment? And so, as you know, there's no universal answer. A buyer with a 10-year plan gets different advice than a buyer with a 2-year plan. A seller with 40% equity gets different advice than someone who bought in 2022 with 5% down. A low rate is valuable, but it should not trap you in a home that no longer works. A home can be a great asset and still be the wrong fit for you in your next chapter. So holding on to a low rate can be smart, but holding on to a house that no longer fits your life just because of the rate is pretty can, financially hoarding, can become financially hoarding with granite countertops. So as we go, the market is not clear, but it is moving. Buyers are writing contracts, sellers are cutting prices, good homes are still selling. Bad pricing is getting punished, and the people who win in this kind of market are not for the people who are waiting for perfect certainty. They are the people who understand their leverage before everyone else sees it. So I hope that helps. Thanks so much for tuning in. We went 40 minutes. We're back with Why Invest Wednesday. I'm so excited to have you guys. Head over to my Instagram account, JKCORealtor_, and you can follow me over there because I need like 40 more followers to be able to go live. So we'll see you next time. As always, give me a call, 303-543-1453, and we can dive into these statistics as they actually pertain to you as a Denver buyer, homeowner, or everything in between. We'll see you next time.